So now we're going to look at this example in relation to the intergroup transaction, and it is a very important in a way concept which we will aim to in a way discuss and understand. So let's look at this question, right? During the year, a subsidiary company sold inventory costing INR 1 lakh to its parent for a sale consideration of INR 1 lakh 10,000. At the year end, the parent has all those goods in their inventory. Consider a tax rate of 30% to be paid at the time of sale. Question is there any deferred tax implication on the above transaction for the group in its consolidated financial statement? Remember, the question here is in consolidated financial statement. Now, when you look at this from a standalone financial statement, right? So you have, let's say, the holding company, and then there's a subsidiary company, right? And let's say assume this is the only transaction you have in this company, right? So I record sales, and let me redo this. Okay, so I am going to first clean this. Okay, I'm going to use a larger space. I need a larger space. Okay. So let's say I have a holding company and I have a subsidiary company, right? So I'm going to do sales, right? So what is a subsidiary? Has sold inventory, right? So in the books of subsidiary, you have a sale of 1 lakh 10,000, right? And then in the books of holding, you have a purchase of 1 lakh 10,000, right? And here I have a cost of sale, right? In the books of subsidiary for 1 lakh. Okay. So here I have a profit of 10,000. Here, this continues to be in the inventory. So in a way, I'm going to knock it off. So in a way, I have zero profit. And then I would apply a tax rate of 30%. So 3,000, right, is a tax. And then 7,000 is my, but what happens is that because there's an intercompany profit, right? There's an intercompany profit. Now, when you're doing the consol financial statement, right? So in the books of subsidiary, there's a profit of 7,000, which is perfectly fine. But when you're doing the consolidated financial statement of H and S together now, so essentially I have a zero sales, right? When you look at, I have a zero sales, I have a zero cost in a way, and this 1 lakh is now into my inventory. So my PBT in a way is zero, and I have a tax expense of 3,000, right? And then I have a in a way loss after tax of 3,000. Now that's the current Indian GAAP situation. Is the way AS22 in a way operate. But when you look at, I'm hoping this is making sense to you, right? So you're a holding company or a subsidiary company. When you look at the standalone financial statement of holding company and subsidiary company, there is a profit of 10,000 in the books of subsidiary, as a result of which there is a tax liability of 3,000. But when you look at the consolidated financial statement, this holding and subsidiary transaction gets eliminated in consolidation, and hence there is no revenue, there is no cost. The whatever 1 lakh rupees there that becomes an inventory in the consolidated financial statement. But the tax which is paid to the government in a way, that stays, and that is what is being addressed in Ind AS 12. Okay, so let's look at the solution here. So calculation of consolidated book base is 100,000, which is the inventory. Consolidated tax base is 1 lakh 10,000. Okay, so there's a, because in the tax it has now increased. Okay, and that is where the difference is, the book base carrying amount minus tax base, which is 10,000. As a result of which the 3,000, which is the current tax expense which you have recorded on this transaction, you will end up recording a deferred tax asset, right, on this 10,000. So on sale of the inventory in subsequent period, the cost of the inventory will be eligible for a tax deduction in future period, and hence the temporary difference is a deductible temporary difference. Okay, because I will get a deduction of how much? 1 lakh 10,000, whereas my carrying value in the consol book is only 1 lakh. So in a way, I have a book base of the asset which is lower, right? And the tax base of the asset is higher. So it's a deductible temporary difference, right? So I'm going to set up a deferred tax asset of 3,000. And that is where, when you look at the consolidated balance sheet of holding and subsidiary, right? So my sales in a way is zero, my cost in a way is zero, and then I have a PBT of 0, and then I have a tax expense of 3,000, right? And then I'm going to record a deferred tax of 3,000. So my PAT is also become 0 in a way. That is how the whole genesis of the transaction is. Okay. So that's how this thing in a way operates. So let me just clean this for you so that you can see this. I hope this is clear to you. Okay. So unrealized profit of INR 10,000 will have to be eliminated from the consolidated income statement with a corresponding reduction in the inventory value from the consolidated balance sheet. Since the goods are sold by a subsidiary to its parent, unrealized profits eliminated will be divided between parent and non-controlling interest in proportion to their holding in the subsidiaries. That could be additional complexity depending upon the percentage of holding we have in this business. Okay, so items which are not having any tax consequence. Let's talk about them. So where the value of the asset does not result into any tax impact, this is considered as a permanent difference. Remember, the India Store doesn't use the word permanent difference. It is like it is defined as events which do not have any tax consequence. So therefore, carrying amount equals tax base, and therefore there is no impact on DTA and DTL. So let's look at this with the help of an example. So in the case of a Mars Limited, which has purchased a machinery for a cost of INR 500,000, which is a useful life of 4 years. Now assume that as per the tax rules, right, there are no deduction available, either for the depreciation or for gain or loss on disposal of the machinery. Corporate tax rate is 40%, right? So essentially it's an initial recognition. There is no item which do not impact tax profit, accounting profit, and they are not going to impact, they are not deductible as well in the future period. So there is this is like an event which do not have any tax consequence. Since there are no deduction either for depreciation on machinery or gain or loss on sale of the machinery, there are no tax consequence, and hence this will be treated as a permanent difference. Accordingly, the tax base and the book base is equals the carrying value, and hence there is no impact on deferred taxes. Deferred tax asset and deferred tax liability in relation to this is going to be 0. All right. So let's quickly, in a way, recap what we talked about. Book base, we got to look at the gap carrying value, a value of the asset and liabilities as per financial statement. Tax base, a carrying value of assets and liabilities following the principles of taxes. Okay, following the principles of Indian Income Tax Act. The deferred taxes are of two types: deductible and deductible temporary differences and taxable temporary differences. And deductible temporary differences results into deferred tax asset, and the taxable temporary difference result into recognition of deferred tax liability, and temporary differences are taxable and deductible, as we've talked about. And we also talked about the principles of thumb rule, right? Which is to say that you got to look at your balance sheet on the asset side and on the liability side. And if you're looking at the asset side of the balance sheet, and if the carrying value of the asset is higher in your accounting books, carrying value of the asset is higher in your accounting books and lower in your tax base, right? That is a taxable temporary difference that results into recognition of a deferred tax liability, right? Now, if the carrying value of the asset is lower, right, like receivables on which you've created a provision for doubtful debt, okay, that means the carrying value of the receivable is lower, but is higher in the tax books, then it results into recognition of a deferred tax asset, because then it becomes a deductible temporary difference, all right? And it goes the other way around on the liability side, okay? So that's what you need to remember. I hope this is making sense to you, and you're able to fully understand and appreciate the concepts around deferred tax assets or liabilities, the deductible temporary difference and the taxable temporary difference. And now we will talk to you about the recognition exception. So there are certain exceptions to the principles we've been talking about, and we will talk about that at length. All right. Okay. So what are these recognition exceptions? I'm just going to take a pause for a second. All right. So what are these recognition exceptions? Let's talk about all of them one by one. Okay. So there are temporary differences, differences between carrying amount and its tax base, right? And that give rise to deferred tax asset or deferred tax liability, as the case may be. Now, there are, in a way, three exception categories in relation to recognition of deferred tax asset or liability. One is in goodwill. So essentially what we're talking about is that if there is a goodwill which is arising on account of business combination, goodwill which is and goodwill is only allowed to be recorded in the case of a business combination under Ind AS 103. Okay. So if you're recording goodwill in relation to a business combination, then you are not, and if let's say that goodwill is not tax deductible, many times that goodwill is not tax deductible, that results into book base of goodwill is like 100 and tax base is 0. So to say, so you are not supposed to record any deferred tax liabilities in relation to goodwill, only goodwill. Okay. You are supposed to record a deferred tax asset or liability, as the case may be, for all other adjustment in relation to business combination, even though they may not be tax deductible. For example, your intangible asset, which you may record in the same business combination accounting, and that's very, very important for you to remember, because that's not intuitive. Okay. So you don't record it on goodwill, but you record it on everything else. All right. Now, if you're doing an initial recognition of asset and liability, and in that case, if this is not in a way giving rise to any accounting or a tax profit, and then if this is not in a way deductible for tax purpose, there also you don't record any deferred tax asset or liability, and we will try and explain this further with the help of an example. And then same goes for investment in subsidiaries, associates, and joint ventures. That what happens here is that, let's say I've invested 100 rupees in my subsidiary X. Okay. And after a year, when the subsidiary has made profit or made losses, right? So in my tax base, that investment continues at 100, but now in my book base, my investment actually has gone up or gone down with the amount of profit that has been made by that entity. All right. And hence, the question comes that should I record a deferred tax asset or liability in relation to that increase or decrease in the net worth of that subsidiary, joint venture, or associate, and we will in a way talk about and we'll also talk about this with the help of an example and help you understand this. Remember, these are exceptions, and hence you got to understand these principles better, okay, as opposed to basic principles of recognition of deferred tax asset or liability. So we'll first talk about goodwill. Initial recognition of goodwill is the recognition of deferred tax is prohibited, as I said. On the subsequent treatment of non-tax deductible goodwill, I don't need to record any deferred tax. There is a scenario where is a tax deductible goodwill, okay? And a scenario could be, let's say, there's a company X and Y, X acquired Y, and as a result of which there is a goodwill of 100 gets originated, and that 100 is actually tax deductible, right? Under the tax laws, it is possible that goodwill is also tax deductible. And if that been the case, then we need to record that for deduction. Okay, that's something important for you. And I'll try and talk to you about this with the help of an example. All right. Let's look at this example. Here, there's a goodwill which is acquired in a business combination, has a cost of INR 100. The above is deductible for tax purpose at a rate of 20% per year, starting from the year of acquisition. There is no impairment on goodwill at the end of year one. Okay. Whether the company needs to recognize any DTL for amortization of goodwill at the end of year one. So essentially, my goodwill is 100. I'm getting a tax deduction of this. And you remember that the goodwill, there is a recognition, there is a deferred tax recognition exemption, right? But that is day zero accounting. Okay. And here now we're talking about day one accounting at the end of the year one, where this goodwill is now tax deductible. Okay. So if this goodwill is tax deductible in the books, my carrying value continues to be 100. And in tax, so in book base, right, continues to be 100. The tax base has now reduced to 80. So there's a higher the book base, the lower the tax base of an asset, in a way results into a taxable temporary difference. And hence I need to then record a deferred tax liability. So the tax base of the goodwill is INR 100 on initial recognition and INR 80 at the end of the year. Entity would need to recognize DTL, deferred tax liability, as it is a taxable temporary difference. Since it does not relate to the initial recognition, differences would get reversed when amount is reduced or written off for financial reporting purpose. Okay. I'm going to take another example in relation to goodwill. Okay. So Omega Limited has acquired a 100% stake in a subsidiary for a consideration of INR 10 lakh. All right. Has acquired 100% stake in a subsidiary for a consideration of INR 10 lakh. On the date of acquisition, carrying amount and fair value of the identifiable net asset is INR 6,50,000. Okay. Below entry is passed in the consolidated books on the date of acquisition. Entry 1, net asset is 6,50,000. Goodwill is 3,50,000. To consideration is 10 lakh. Okay. So net asset is 6,50,000. Goodwill is 3,50,000. Okay. And then to consideration is 10 lakh. Awesome. So goodwill is the balancing number here. On initial recognition, the tax base of the goodwill is 0. Therefore, the taxable temporary difference is INR 3,50,000. Okay. But do you record any deferred tax on this? That's the rule, right? Now, assuming the tax rate to be 30%, deferred tax liability of INR 1,05,000 needs to be recognized on this 3,50,000. But as we said, there is a recognition exemption, right? You are not supposed to do this. Essentially, what will happen here, if you were to record this on 30% on this, it in a way creates a circular reference, right? It in a way creates, because see what will happen is that my allocation will change, right? So it will then become let's just look at this. Okay, we have it in the following slide. So the above recognition of deferred tax liability will result into the revised entry, right? Or as we passed, so which is 6,50,000, increase the goodwill by 4,55,000, which is basically 3,50,000 plus 1,05,000, right? And then the consideration, right, continues to be in a way 10 lakh, and then you record a deferred tax liability of 1,05,000. Okay, so in a way this entry gets loaded here. Now, but again, if you see this guy is not representing 30%. Okay, so in a way it's a circular reference, so you'll have to apply a simultaneous equation to get to the right answer here. But I think the rule here, the Ind AS 12 in a way says that you are not allowed in a way to record goodwill in a business combination. If you acquired goodwill, and goodwill you only acquire in a business combination, so if you're doing a business combination and recording a goodwill, then you are not required to record a deferred tax liability in relation to that goodwill, even though the tax base of that is zero. This exemption is only for exception, is only for goodwill, not for other intangible assets, right? Which you acquire in a business combination. Remember this, right? People often make mistake that you not only look at it for goodwill, but you also look at for others, for other intangible assets like customer related, marketing related, non-compete, brand, copyright, whatever else other intangible asset you have. And if there is a difference in the book base and the tax base of that other intangible or other adjustment arising in a business combination, you are also required to consider the deferred tax impact of the same, right? Whereas only in case of goodwill, there is this exception. So that's the explanation here, right? From that perspective, that is why it results in towards it, the treatment is not permitted. All right. So now let's talk about other initial recognition exception. Okay. So you do not recognize temporary difference arising on initial recognition when it arises from a transaction that is not a business combination, and at the time of the transaction, it affects neither the accounting profit nor the taxable profit. And accounting profit clearly means any item recognized in total comprehensive income. And there's a very limited application, mainly when assets have deemed value under tax laws. Okay, assets have deemed value under tax laws. Okay, now we are going to look at this example in relation to initial recognition. So let's look at this question. Royal Limited has imported an equipment for INR 500,000 from the original equipment manufacturer. The purchase is not part of the purchase is not part of any business acquisition, so to say. As per the tax rule of the jurisdiction, there is no deduction or allowance for depreciation on the equipment. Okay, so Royal Limited has imported an equipment for INR 500,000 from the original equipment manufacturer. The purchase is not part of any business acquisition. As per the tax rule of the jurisdiction, there is no deduction or allowance for depreciation on the equipment. Further, at the time of disposal of the equipment, the related gain or loss are not taxable or deductible. Therefore, the tax base of the equipment is nil, and hence a temporary difference of INR 500,000. Okay, the corporate tax rate is 30%. Okay, so the question here is whether Royal Limited should recognize a deferred tax liability of INR 150,000. So essentially, we're saying that there is no deduction allowance for depreciation. At the time of disposal, the related gain or loss are not taxable or deductible, right? The tax base is zero. So essentially, there is an initial recognition exemption, as we talked about, and there is nothing which needs to be done. As per the standard, deferred tax assets should not be recognized on temporary differences arising on initial recognition. If it arises from a transaction that is not a business combination and affects neither accounting or taxable profit at the time of the transaction. Hence, the deferred tax liability of INR 150,000 should not be recognized. It is not considered as in a way, taxable temporary difference. Okay. And hence nothing needs to be done here. You may require to make some suitable disclosures. It may require to be disclosed as part of the tax rate reconciliations and so on and so forth. Right. Now let's talk about a third kind of an exception, which is investments in subsidiaries, joint ventures, and associates. Okay. Now, temporary differences must be considered at the parent and consolidated entity level. And I was trying to explain this, right? That when I made an investment of 100, right? This is, let's say I made an investment in my subsidiary X, and I am like H holding company. Okay. And then when I look at this, right, this my X has made, let's say during the year when in their X standalone P&L, they made a profit. Okay, they made a profit of say 20. Okay, so now in the consolidated P&L of H, right, the carrying value of the assets and liabilities of X in the consolidated balance sheet of H is actually 120. Okay, so when you compare 120 with my investment cap of 100, there is a delta of 20. Now the question is, now do I need to record a deferred tax liability because my investment value in my consol books for X is higher at 120, whereas my tax base, this is called outside basis tax difference, okay, is only 100. So do I need to record this? Okay, so must be considered the parent and consolidated level. Okay, may arise from, so why this 20? This 20 is actually an undistributed profit, or it can also happen because of the foreign exchange rates, right, because of the currency fluctuation. This may arise through a currency translation adjustment. And then it also there to the carrying value investment in the parent on impairment of goodwill. All of this in a way can result into a temporary difference. So you need to record temporary difference, must be recognized subject to exceptions. Okay, subject to exceptions. So now, what are these exceptions? Recognize all taxable temporary differences except, right, when the parent controls timing of the reversal of the temporary difference, like this. So this 20 in my example, right, this 20 in my example, in a way the distribution of this is controlled by the parent. Let me give you a simple example. Let's say this there's a company, let's say Reliance, right, and then Reliance is a subsidiary, right. Now if the subsidiary has made a profit, now whether a Reliance needs to provide for a deferred tax liability in their consolidated books, that is actually, it's obvious that Reliance, because the subsidiary, I control the distribution of profit by the subsidiary, and hence I am not required. Now if I take a decision that I'm going to distribute this, and if there is a tax incidence on that distribution, then you are supposed to record deferred tax liability, right? And why deferred tax liability? Because the taxable temporary difference, which is a higher the carrying value of the investment or the asset in my consol books versus in my tax books. Okay, that is why it's a taxable temporary difference. It is probable that temporary difference will not reverse in the foreseeable. So these are the two reasons when I control, or it is probable that it will not reverse in the foreseeable future. Okay. Now, when you look at the, when I need to record it, the temporary difference will reverse in the foreseeable future, right? And there will be taxable profit will be available against which the temporary difference can be used. So only two scenarios in which I need to record when the temporary difference will reverse in the foreseeable future, and taxable profit will be available against which the temporary differences can be used. Okay. So what we will do is we'll also try and understand this with the help of an example. Okay. So as I said, as a parent, I control the dividend policy of the subsidiary. So it is perfectly fine to control the timing of the reversal of the temporary difference associated with that investment. I just gave this example of Reliance. Now, when the parent has determined that undistributed profit of subsidiaries will not be distributed in the foreseeable future, again, you don't record a deferred tax liability. Same is applicable to investment in branches as well. Same is applicable to investments in joint ventures as well, but it is not applicable to investment in equity method associates. Okay. Why? Because joint venture, you can still control. The decision has to be taken jointly, but not in equity method associates. Okay. And similarly, if it is to be determined in a different currency, it can give a result. So we need to assess that whether that results into a distribution or not. All of that is what required to be assessed. So now we are going to look at this example, right? Which is Aqua Limited purchases the entire shareholding of PQR Limited for INR 6,000 on 1st of April 2020. Okay. Corporate tax rate for Aqua Limited is 30% and for PQR Limited is 40%. So we have two different tax rates, and I've acquired the 100% shareholding. Okay. Now, on the date of acquisition, the following are the fair value of the identifiable assets and liabilities, right? Excluding the deferred tax asset and liabilities of PQR Limited, which is acquired by the Aqua Limited. Now, tax base for the same in as per PQR tax jurisdiction and the resulting temporary differences, okay, are as follows, okay. So PPE, which is 2700 is the fair value. The tax base of that PPE is 1550. Okay. So fair value is higher. Similarly, the account receivable, it's the same inventory. The fair value is higher than the tax base. And retirement benefit obligation is a higher obligation than the tax base, is zero virtually. And accounts payable is same, right? So fair value of net assets excluding goodwill is 5040, and tax base of that is 3690. How much I paid? I have paid 6000, right? I have paid 6000. Okay. And the Aqua Limited has paid 6000, and Aqua Limited corporate tax rate is 30%, whereas PQR Limited tax rate is 40%. Okay, 40%. Now, the question here is determine the goodwill to be recognized on the date of acquisition. First question is to determine the goodwill to be recognized on the date of acquisition in the consolidated financial statement. Further, where there is any deferred tax impact in consolidated financial statement on the date of acquisition. Okay. The two questions is what we need to address here. So let's look at the solution, what we have. So when you look at the date of acquisition, we will do the computation of goodwill. So we know the consideration, we know the fair value of the net assets, as we know the resultant difference, is goodwill. And then we also need to record the deferred taxes, right? So we know the difference is 1350, right, which is the difference, and the tax rate, which is 40%. So 540 is the amount of deferred tax liability which we are required. This is a very, very important thing what you need to remember. So even though the tax base continues to be, let's say, historical tax base, you need to record a deferred tax asset or a liability in relation to a business combination, except goodwill, right? Goodwill is the only exception, but other items you need to record. There is no dispensation on that. So deferred tax 540, fair value of net assets is 4500. Okay, and then the goodwill is the balancing figure, which is 1500. That's what we are getting here. My carrying amount was 6000. Okay, carrying amount. So total consideration, right? Total consideration I paid is 6000. 4500 is my net asset after adjusting for deferred tax liability. So we get to 1500 as the goodwill. So as per Ind AS 12, deferred tax liability is not recognized on initial recognition of goodwill. Exceptions to the recognition of deferred tax liability. Simple question, but I think many times we go wrong because we don't apply or we don't recognize the deferred tax liability on this fair value adjustment, and as a result of which my goodwill computation go wrong, right? So everything else is provided. This is provided here, right? This is provided here, right? But this is what I have computed with reference to the tax rate, and then this becomes the delta. In a way, this becomes the delta, right? Which becomes the balancing number, goodwill. Goodwill is what? Nothing but unidentified intangible assets, which are subsumed, right, together as called goodwill. I have to do certain disclosures here, okay? Certain disclosures are required. So let's just quickly recap the exceptions: initial recognition of goodwill, initial recognition of assets and liabilities, and investments in subsidiaries, associates, and joint ventures. All right. Okay. So we talked about the recognition exception principles. Okay. Again, keep that in mind. So current tax gets driven by Income Tax Act. Then we're talking about deferred tax. For the purpose of deferred tax, I'm going to look at a book base of the asset and liability, compare with the tax base of the assets and liability. Now that I'm going to categorize them into taxable temporary differences and deductible temporary differences, and I'm also going to look at items which do not have a tax consequence. And then I'm going to look at the recognition exception, and I'm also going to look at the so basically differences which are also arising only on consolidation, not at only at standalone. And we talked about one such difference which is coming, let's say, in relation to inventory or transaction between intercompany, which where those balances are still lying within the group companies. And those profits are not profits are eliminated, but the tax is not eliminated, and that's where tax also needs to be eliminated. And then we talked about the recognition exception, which is on goodwill, which is on items which do not result into recognition of any accounting profit or taxable profit on day zero. In that consequence, and then third is in relation to my investments in joint venture, subsidiaries, and associate. Here I talked about for subsidiaries and joint venture, the ability for or associate, you generally do not consider the ability to stop the distribution of dividend, and hence you may have to provide for deferred tax liability, provided there is a tax incidence on such distribution. All right. Okay. So now we're going to talk about the measurement of the tax asset or liability. So I'm going to measure it with reference to a tax rate or a substantively enacted tax rate at which it is likely to be settled in the foreseeable future. So current tax liabilities for the current and prior period shall be measured at the amount expected to be paid to or recovered from the taxation authorities, which is based on the tax rate which is applicable for that kind of transaction under the income tax law for that assessment year. Using the tax rate that have been enacted or substantively enacted by the end of the reporting period. Now, deferred tax assets and liabilities shall be measured at the tax rate that are expected to apply to the period when the asset is realized or the liability is settled, okay, based on tax rate that have been enacted or substantively enacted by the end of the reporting period. Right now, you all know that India substantively reduced the corporate tax rate, right, from let's say 30% to so to say 22%, right. It was a substantial reduction, okay. So in a way, for current tax for that year, you will continue to do 30%. But for my deferred tax, which are there, I'm going to apply the new rate. Even though current tax for that year will continue to be 30%, the deferred tax will be applied at a new, because deferred tax by definition is going to be settled in a future period, right? In a future period. So you want to apply it with the rate at which it is likely to get settled, the rate at which you're likely to receive the benefit or you have to pay to the government of India, from that perspective. Okay. So when different tax rate apply to different levels of taxable income, measurement will be based on average rates expected to apply in the period in which the temporary difference. So if there are slabs, which is not the case, which is the case for individuals, for example, but not the case for corporate tax rates in the country. The measurement shall reflect the tax consequences that would follow from the manner in which the entity expects at the end of the reporting period to recover. So, for example, if there are long-term assets or short-term capital gains, and there are different tax rates, so you're going to factor all of that, right? That in what form or manner I'm going to be able to realize this tax benefit or liability, and then what tax rate will be applicable to that asset or liability. All right, we're moving forward. So now we're going to look at this example. An asset has a carrying amount of INR 100 and a tax base of INR 60. A long-term capital gain tax rate of 20% would apply if the asset is expected to be sold after 3 years, and tax rate of 30% would apply in case it is expected to be sold before 3 years. Awesome. Now explain if any deferred tax or asset or liability should be recognized at the end of a year. If yes, calculate the same. Okay, so now we have to calculate the So here, if you see my book base is 100 and my tax base is 60. There is a difference of 40. So certainly there is a difference of 40, right? And the first question, whether it is a deductible temporary difference or a taxable temporary difference, right? So what do we have here? We have higher the book base of the asset and lower the tax base of the asset. Means what? We have either claimed higher depreciation in my already tax return, or I have written it off faster in tax compared to books. So it is a case of a taxable temporary difference. In future years, I'll have a lower profits, right? Whereas I'll have a higher tax liability, right? So that is why we call it as a taxable temporary difference. So this 40 is a taxable temporary. Now the question here is that if I were to realize this after 3 years, then I get a capital gain of 20%. If I were to sell it after 3 years, then and the tax rate of 30% if I were to sell it before 3 years, right? And that's the difference, right? So how do we in a way determine the tax rate to be applied here? Okay, so the entity will recognize the deferred tax liability of INR 8, which is on 40 at the rate of 20%, if it expects to retain the asset and sell it after 3 years. Otherwise, a deferred tax liability of INR 12. So it goes by your own assessment. The important thing is goes by the assessment of the entity, right? It is a management assessment that in what form and fashion they will be able to realize this taxable temporary difference, and that is what will determine the rate which is applicable in this situation. Awesome. So we're going to look at this example. Good Group Limited has an asset which was purchased for INR 1000. The carrying value of the asset is INR 800, which is revalued to INR 1500. Okay, Good Group Limited has an asset which was purchased for INR 1000. The carrying value of the asset is INR 800, which is revalued to INR 1500. For the purpose of tax, no such adjustment is done for revaluation. Tax depreciation is INR 300 till date. That means what's my tax base? When I purchase it for 1000, I've recorded a depreciation of 300. So my tax base is 700, right? And now my book base has become 1500. Tax depreciation of INR 300 will be included in taxable income if the asset is sold for more than its cost. However, sale consideration in excess of the cost is not subject to tax. Corporate tax rate is 30%. So tax depreciation of INR 300 will be included in tax if the asset is sold for more than its cost. Okay. However, sale consideration in excess of the cost is not subject to tax. Corporate tax rate is 30%. So the question is, what is the impact of above on tax calculation under Ind AS 12? All right. So let's look at the solution. Remember, this is not there is no initial recognition exemption which is happening here. Okay. So we purchase this asset for 1000, we're getting a deduction, and then if we were to be able to sell it, right, then we will get a 300 will include in taxable income. And in excess of the cost is not subject to tax. So corporate tax rate is 30%. So let's look at the solution here. In case the asset is retained and used for business purpose, calculation of book base is how much? We saw, which is it was 800 and then did 1500. So 1500 is the revalued amount. The tax base is 700, right? So the temporary difference between the two is 800. Okay. And so it is a taxable temporary difference of 800, right? Causing a future tax liability is taken through OCI due to upward revaluation of the asset. Okay, all of this is being taken through the OCI. Okay, so if Good Group Limited expect to recover the carrying amount by selling the asset, if you were to by selling the asset, tax liability, so my sale proceed is 1500, and my sale proceed in excess of cost is 500, right? My taxable proceeds are 1000, and my tax base is 700. Okay, so in a way 300 is the taxable temporary difference. Okay, because that is what I am maximum liable for taxation, and tax rate is 30%. My current tax liability is 900. So in a way, this is done and dusted. Okay, so I'll end up paying current tax of 90 rupees. Okay, done and dusted. There's no deferred tax here, because it's essentially, if I'm going to selling it, this is how I need to deal with this. Okay. So quickly, in a way, revisit what we have talked about. So when you look at a measurement of tax rate, you're going to apply the enacted or substantially enacted tax rate. And when you look at the current tax, you're going to apply that tax rate which is applicable for that year, that assessment year. All right. When you look at a deferred tax, you're going to apply it with reference to the year tax rate which is prevailing for the year in which that deferred tax asset or liability is likely to be settled. Okay, is likely to be settled. So current tax enacted or substantively enacted by the end of the reporting period. From a deferred tax perspective, expected to apply to the period when the asset is realized or the liability is settled. All right. Okay, so now we're going to talk about few more concepts as they are under Ind AS 12. Okay, so we're going to look at the recognition criteria for deductible temporary differences and tax losses. So essentially what's happening here is that I want to record an asset, right? Then I'm going to go by the general principle that is this asset is realizable or not? Is this asset is realizable or not, right? Because government is not going to give me back, right? And you should know this, right? In US, they have an interesting concept which is called carry back, okay? So, what happens, and I'll try and help you understand with the help of example. Let's say, if you are operating a business in US, and let's say you are X Limited, and we are talking about year, let's say 2018, 2019, and 2020, right? Now you made a profit of 100 here, profit of 100 here, and let's say loss of 200 here. Okay. So what happened, let's say the tax rate is 30%. So essentially you paid a tax of 30 year. Now you come to 2020, you've not made any profit. So there's no question of you paying the tax. But what happens, here now in India, you have to pay tax of 30, and here, you don't get any tax refund from the government, right? But in US, what they say, this loss of 200, assuming there's also a tax loss of 200, you can carry back. So in India, you can only carry forward. Okay, we can only carry forward. But in US, you can actually carry back your losses to also a specified number of years, like ordinarily 2 years actually. Okay. So essentially this 200 you can carry back. And if you pay taxes in these years, you can actually take the refund. Okay. So in a way, you not only realize your deferred tax asset with reference to carry forward of losses, but also the ability to realize with reference to carry back. Okay, but that's not there under the Indian tax laws. Okay, under Indian tax law, this benefit doesn't exist. Okay, so when you look at DTA, deferred tax asset should be recognized. It should be recognized to the extent it is probable. To the extent it is probable is defined as more likely than not. Okay, probable is defined as more likely than not, okay, probable is defined as more likely than not. Okay, so DTA should be recognized to the extent it is probable that taxable profit will be available against which the deductible temporary differences can be utilized. Now, probable is not defined as 12, but it is interpreted as more likely than not. It is interpreted as more likely than not. Now, review of carrying amount of DTA at each reporting date, at each measurement date, so to say. Reassessment of unrecognized deferred tax asset is also required at each reporting date. Okay, discounting is prohibited, not allowed. There's no even though you expect that this deferred tax asset I'm going to realize in 10 years down the line, asset will continue at the gross value. It will not be discounted to the, so I paid the tax today and I'm going to realize it after 10 years. You don't do any discounting to reflect the time value of money. Okay, it is no discounting. Discounting is prohibited. Discounting is prohibited. All right. So, so there has to be. So, how do you evidence that this deferred tax asset is realizable? Either you have sufficient deferred tax liability available relating to same tax authority and same entity in the same period. Probable sufficient. If you don't have it, you'll make sufficient taxable profit in the future period. If you don't even have it, then you look at the tax planning opportunity. Can I do some tax planning, right? Some merger, amalgamation, which is in your control, as a result of which you will be able to then realize some of these tax losses. Okay. If you say again no, then no recognition of deferred tax asset. Okay. If the answer to that is yes, that you have deferred tax liability, which relates to the same entity, same geography, same jurisdiction, and all of that, then you can offset the two, right? Offset the two. Then you can record the deferred tax asset, or no, you'll have sufficient taxable profit in the future. Then you record the deferred tax asset. If the answer to all of these is no, then you are not allowed to record any deferred tax asset. End of the day, monetize this. Okay. End of the day, I'll leave you to monetize this. Okay. End of the day, I'll leave you to monetize this. If the answer to that is yes, record this. Otherwise, don't record this. Okay. So I'm going to look at this example. For the financial year ended 31st of December 2020, Berlin Limited has operating losses to the extent of INR 10,000. Now, Berlin Limited expects that these losses can be offset in subsequent year profits. Okay. For the financial year ended 31st December 2020, Berlin Limited is operating losses to the extent of 10,000. You expect that these losses can be offset in subsequent year profits to be carried forward for next 8 years. My corporate tax rate is 30%. What is the deferred tax implication of the above offset? So if I believe that I'll be able to set it off, so essentially on this operating loss, I'm going to, it becomes in a way a deductible temporary difference. So I'm going to record a deferred tax asset on this. It is probable that taxable profits will be available against which the deductible temporary difference can be utilized in future period, which is next 8 years. The deductible temporary difference for the year ended 31st December 2020 can be offset against that. Hence, we should create a deferred tax asset of INR 3,000. Awesome. On the other hand, if Berlin Limited does not expect taxable profit in future years, against which such deductible differences cannot be offset in a way, then there will not be any deferred tax asset, and there will be no benefit on the cash flow, and hence I don't need to set up the deferred tax asset. We may have to do some disclosures. Now let's talk about the recognition and reversal of tax effect through profit and loss account or equity. Okay. So if the gain or loss in relation to that item to which the deductible or taxable temporary difference pertain, if that gain or loss is recorded through P&L, right, then the deferred tax asset or liability will also be recorded in the P&L. Okay. If the gain or loss is recorded directly in equity, then the deferred tax asset is also to be recorded in other comprehensive income. All right. So recognized as income or expense to the extent that the tax arising from is directly in equity or in business combination. So if it is in business combination, you adjust it as part of goodwill, right? And remember the exception, you don't record any deferred tax liability on goodwill itself, okay? In the case of reversal also, the tax effect follow recognition of initial transaction. Tax stays in equity until the underlying transaction impacts the P&L, right? Now we are going to look at this example. Antarctica Limited had purchased a machinery for a cost of INR 150,000. Okay, Antarctica Limited had purchased a machinery for a cost of INR 1,50,000. The machinery has a carrying value of INR 70,000. Okay, so Antarctica Limited purchased the machinery for a cost of INR 1,50,000. The machinery has a carrying value of INR 70,000. After considering accumulated depreciation of INR 50,000 and an impairment loss of INR 30,000. So on 150, I have done a depreciation of 50 and an impairment of 30. As per the tax law, impairment loss is not deductible for computing taxable income. My corporate tax rate is 20%. What is the deferred tax consequence? What is the deferred tax consequence here? So essentially, I would again determine my book base is 70,000. My tax base is 100,000. So difference is 30. Tax rate of 20%. So the question is, this 30 is a deductible difference or a taxable difference, right? Now this 30 is a deductible temporary. Why? Because my book base of the asset is lower and tax base of the asset is higher, right? So it results into a deductible temporary difference. Hence, I need to set up a deferred tax asset on this, okay? So let's look at the solution. 150 carrying amount, tax based on initial recognition, then accumulated depreciation, 50,000, 50,000. My impairment loss of 30,000, not allowed in tax, and then my tax rate is 20%. So my deferred tax asset is 6,000, which is deductible. Temporary difference. Awesome. Okay. All right. So we're now going to look at this example. So as at 31st of December 2020, MNO Limited has a PPE, property, plant and equipment, purchased at a cost of INR 15,000. Accumulated depreciation as per books and tax purpose is INR 8,000. MNO Limited carries out a revaluation and the revalued amount of PPE is INR 20,000. Tax rules do not consider revaluation. Now the corporate tax rate here is 30%. Now we need to pass the journal entry for the revaluation, including the Ind AS 12 impact. Awesome. So essentially my book base has now become 20,000, right? My tax base continues to be 15,000 minus 8,000 is 7,000. So the difference here is 13,000, which is what I need to look at recognition at the rate of 30%, which is 3,900. So the gain, which is OCI, it will go to OCI, the 13,000, and then the deferred tax liability, right? It's a taxable temporary difference. Why? Because now when the book base is higher, the tax base is lower. So it's a taxable temporary difference. So let's look at this solution on a step-by-step basis. So first you got to calculate the book base, as we said, which is now 20,000 after considering the revaluation. The tax base, so we saw there is a depreciation of 8,000, right? So tax base of 15,000 minus 8,000 is 7,000. The temporary difference is 13,000. That means it is a taxable temporary difference, right? Tax rate is 30%. So I get to 3,900, and then I'm going to now record the journal entries, which is revaluation, debit property, plant and equipment 13,000, credit revaluation surplus, which is OCI by 13,000. Okay. And then recognition of deferred tax liability, which is a debit tax expense 3,900, and credit deferred tax liability by 3,900. Okay, that's how we're going to do this accounting. So it's essentially, if the gain or loss goes to OCI, the deferred tax asset or liability also will go to OCI. I think that's the principle which we need to remember. The deferred tax asset or liability follows the primary treatment of the underlying transaction. If it goes to P&L, then the deferred tax asset or liability also goes to P&L. If it goes to OCI, the deferred tax asset or liability will also go to OCI. So recognition of deferred tax asset, I need to have sufficient deferred tax liability available in future, or I should have taxable profits available in future, or I should have the ability to do a tax planning strategy. Recognition and reversal through P&L or equity, it depends upon the originating transaction through P&L or OCI. Reversal tax effect follows recognition of initial transaction. All right, so we've now covered a good substantial part of our module on deferred taxes, right, in DS 12, right? So just kind of again to give you the entire thing, right? What we're trying to say here is that you're looking at, when you look at taxes, right? Taxes are divided into two components: current tax and deferred tax. Okay, current tax are computed with reference to the income tax law, right? Now, when you come to why then there's a need of deferred tax, the need of deferred tax, because there is a difference in computation of income under accounting laws versus tax laws. Okay, now there results a difference. Now we are trying to bridge this gap in terms of my tax expense. Now I'm trying to bridge this gap in terms of my tax expense. So how am I doing it? I'm doing it by bringing in the concept of deferred tax asset or liability, deferred tax expense. And if I do this, I'm going to follow a balance sheet approach. Okay. Now, for the purpose of following a balance sheet approach, I look at the book base of my asset or liability, and I compare it my tax base of asset and liability. The difference between the book base and the tax base are called temporary differences. Okay. Now, these temporary differences could be a taxable temporary difference or deductible temporary difference. The taxable temporary difference results into a recognition of deferred tax liability. A deductible temporary difference results into a recognition of deferred tax asset. And then there could be some differences which we say which do not have tax consequence, and they are permanent differences, so to say. Okay. Now, on the taxable temporary difference and deductible temporary difference, you will apply the applicable tax rate for that kind of asset or liability in the manner in which it is likely to be settled, and you go to record a deferred tax asset or liability. And then you also look at, will I be able to realize this deferred tax asset? You want to apply the test of probability, which is interpreted as more likely than not. And then you would look at, do I have sufficient deferred tax liability? If yes, then it is an evidence that I'll be able to realize this deferred tax asset. If I have sufficient profit in the future, then it is an evidence, or I'll make sufficient profits in the future, right? Or I can do a tax planning strategy. Then we also talked about there are certain exceptions to recognition of a deferred tax asset or liability. And we said, if you're doing a business combination and there's a goodwill which is recorded as part of that transaction, you don't need to record a deferred tax liability, right? At initial recognition in relation to goodwill. Remember, goodwill is the only exception, but not for other adjustments to fair value assets and liabilities in relation to a business combination. Then we looked at undistributed profits of joint ventures, subsidiaries, and associates. Do I need to record? And it's not only about undistributed surplus, it's also about losses, right? And then we said that if the ability to control it, if you don't want to distribute it, then you don't. If you expect these losses to be realizable in next foreseeable future, which ordinarily is defined as 1 year, then you need to, otherwise you don't, from that. And we also looked at if there are any asset or liability recorded on day one, if there's a difference, do I need to record? If this do not have tax consequence, that also was another exception. Then we very beautifully, we talked about this whole concept of intercompany transactions in the context of inventory, for example, right? Sale of inventory from one company to another company. Now, if that has happened, then we said that, even though the tax is paid in individual entity, but in consolidated level, if you still have the inventory lying there, then you need to also eliminate the deferred, the income current tax which you paid by recognition of deferred tax. It creates a temporary difference at the consolidated level, and hence that also needs to be considered. All of that is what we've talked about, over last several hours, in order for your ability to understand with the help of several examples. Now let's quickly talk about presentation and disclosure. And as we've been learning through Ind AS, it says disclose, disclose, and disclose. Please disclose, all right? So DTA and DTL, as well as current tax assets and liabilities, should be presented separately from other assets and liabilities in the balance sheet. They should not be classified within current assets. And also remember, they're not allowed to be discounted, right? Disclose, deduct the deferred tax asset or liability because of deductible temporary differences, unused tax losses, and unused tax credits, for which if you've not recorded deferred tax asset, you got to also look at presentation of interest and penalties, right? And there are some policy choices. Interest and penalties levied under Income Tax Act, no deductible as part of the tax charge, any expense in arriving at profit before tax. You should determine the accounting policy, for such item and apply it consistently, whether you want to present this as part of your income tax expense line item, or you want to present this as part of your other income expense line item. So whatever you decide, you present it consistently. And many times these are tax deductible. You got to again evaluate it appropriately. The aggregate amount of temporary differences associated with the investment in the following for which deferred tax liabilities have not been recorded, that also you need to disclose. So essentially what I'm trying to say, a bunch of disclosures, which are required, and you will, if you should, I would encourage all of you in a way to look at the financial statement of a company has been prepared, which are prepared under Ind AS of a large company, right? And then go and see the disclosures which they have made in relation to Ind AS 12. You will see a whole host of these disclosures which are being made, okay? Very beautifully, these disclosures are being made. They give you a bird eye view of the entire tax exposure and positions taken by of this company. The income tax consequence of dividend to shareholders, all of that you need to disclose. And again, explanation of the relationship between. So you got to also do what we call as tax rate reconciliation, okay? Tax rate reconciliation. How does this done? For example, I have a, you should again see this, right? What is it? So for example, my PBT, okay, is say 100, right? And tax rate as applicable to me is 30%. So ordinarily, my tax expense should be 30 and my PAT should be in a way 70, okay? But what happens many times that your tax expense is actually not 30, but it is 25. So essentially, so when you look at with my tax rate, with tax rate, my tax would have been 30, but actually I have 25. So you got to, find out what are the reasons that why your tax expense is not mirroring the statutory tax rate, which is applicable to the jurisdiction in which you are operating, right? And that's what is required to be done here. All right. So now we're going to talk about this example in relation to the disclosure requirements. So for the year ended 31st of March 2020, Stars Limited has an accounting profit of INR 10,000, which is arrived at after deducting a penalty paid for INR 1,000. The penalty is not an allowable expenditure as per the tax rules of the country. There are no other items which has an impact on tax. Corporate tax rate is 30%. Considering the above, the taxable profit is INR 11,000, right? 10,000 plus 1,000, and therefore tax expense is INR 3,300. Okay. So now we are required to pass the rate reconciliation under both approaches, right? And you remember the both approaches which we talked about, right? One is that you do a rate, tax rate in a way, or you do on a gross amount, right? There are two ways you can do this rate reconciliation disclosures. Okay, so the taxable profit here is 11,000 and rate is 30%. So my tax expense is 3,300, whereas my accounting profit is how much? 10,000 only. So if I were to apply the statutory tax rate on 10,000, I only get 3,000, whereas my tax expense is 3,300. So I need to reconcile. How do we do that? So basis on the disclosure alternative, there are two types of disclosures, right? Alternative one, I'm going to do this. Accounting profit is 10,000. Then I have tax at the applicable tax rate is 3,000. And then items which are not allowed to be deducted is 300 of 1,000, which is the penalty. And the tax effect of that is 300. So my total tax expense is 3,300. That's one way of doing the disclosure. Okay. The other way of doing the disclosure is I'm going to look at the percentages, right? So what was my tax rate is 30%. Same item, tax effect of expenses that are not deductible in determining the taxable profit is penalties. The impact of that is 3. My average effective ETR becomes 33%. The ETR as per the national income tax rate is 33% here, right? So whereas actual tax rate, the country tax rate is 30, but my tax rate is 33, which is reconciled in this fashion. All right, let's look at similarly another example. Okay, so in 2020, an entity has accounting profits in its own jurisdiction, which is country A of INR 1,500. And in 2019, it was 2,000. Okay, both the years we are talking here. And in country B of INR 1,500 and 500, the tax rate is 30% in country A and 20% in country B. In country A, expenses of INR 100 are not deductible for tax purpose. And the following is an example. So how do you do the example in terms of reconciliation of tax rate for 2018 and 2019 and 2020? Okay, so you look at the accounting profit, which is 1,500 plus 1,500, right? So here A plus B is 1,500 plus 1,500, right? You get to 3,000. Here it is 2,500, which is 2,000 plus 500, right? You get to 2,500. Then you have the tax. You have to apply the tax at the rate of the holding company, okay, which is country A, assuming, which is a holding company. So it's 30% is 900 at the rate of 30%, and here it is 750. But the profits of B are taxed at a rate of 20%. So there is a differential tax rate for certain profits. Okay. So tax effect of, first you want to look at tax effect of expenses that are not deductible for tax purpose. What is non deductible? In country A, expense of INR 100 are non deductible. And what was the tax rate? Which is 30%. So essentially it is 30 here and it is 60 here, right? On 100, right? At the rate of 30%, and here on 200 at the rate of 30%. And then you look at the lower tax in country B, okay, which is 20%. So how much the country B profits were in year 2020? They had 1,500 on 10% is 150. Okay, 150, and here it is 50. And then my tax expense is 780 and 760. All right, that's how you do the reconciliations or the disclosure presentations. Let's look at this example now. On 31st of March 2020, Moon Limited has a deductible temporary difference of INR 5 lakh for an expense disallowed as per tax rules. Okay. On 31st of March 2020, Moon Limited has a deductible temporary difference of INR 5 lakh for an expense disallowed as per tax rules. There are no taxable temporary difference for offset. Moon Limited does not expect profit in the foreseeable future. However, so I don't expect profit in the foreseeable future. Okay. However, Moon Limited is of the opinion that it can generate profits of INR 6 lakhs by using tax planning strategy, which has an attached cost of INR 1 lakh 20,000. My corporate tax rate is 30%. So the question here is, should Moon Limited recognize DTA? And if yes, at what amount? Okay. Should Moon Limited be recognizing DTA? And if yes, at what amount? All right. So again, you got to look at when you think about this strategies, right? So I have a 5 lakh rupees of temporary difference, which I am unable to offset because I don't believe that I will have enough profits in the future. So it's a deductible temporary difference, right? So I need to have probable evidence that I will be, which is called more likely than not. Now then I need to look at my tax planning strategy, and the tax planning strategy here, which is in my control. I believe by doing that, I can actually generate a profit of 4 lakh 80,000, right? 6 lakh minus 1 lakh 20,000. So this is I'm going to generate, this is I'm going to cost. So net is I'm going to be in the money by 4 lakh 80,000. So essentially, out of 5 lakh, I have now a strategy in place that I will be able to leverage 4 lakh 80,000. So do I need to set up a DTA? Absolutely, yes. I should set up a DTA up to 4 lakh 80,000, which will be 1 lakh 44,000 at the rate of 30%, which is 1 lakh 44,000. Now the remaining on 20,000, there is no DTA which is allowed to be set up because I don't have the visibility of this being available for offset in the future period. All right. So we're now going to look at this example, which is Popular Limited uses accrual system of accounting, who is not using it, for recognition of interest income in its books of accounts. On December of 31st, 2019, Popular Limited has recognized an interest receivable of INR 100,000 and the corporate tax rate was 25%. I have to receive income. Okay. On February 28, 2019, the finance bill is introduced. On February 28, 2019, the finance bill is introduced, which changes the tax rate to 30%. The finance bill is enacted as act on May 15. So this actually should be, I think there's some typo here. This should be February 28, 2020. Okay. The finance bill is introduced, which changes the tax rate to 30%. The finance bill is enacted as act on May of 15, 2020. As per tax rules, interest income is taxable on in cash basis. Okay. Now, determine the deferred tax impact considering Popular Limited reporting date is December 31st and the financial statements are approved for issue on May 31st, 2020. So essentially, we are saying that there's a new law which is getting passed here, and then what do? Should you change it? Should you not change it, right? So it is an adjusting event or it is a non-adjusting event, right? So essentially, you will do it for tax rate which is there on the date of the balance sheet, not on the date of the signing of the balance sheet. Okay, so let's look at the solution here. The recognition of interest income on accrual basis by Popular Limited for accounting purpose and its taxability on cash basis creates a taxable temporary difference of INR 100,000. Therefore, a deferred tax liability needs to be recorded. There is no dispute on that. Now, the tax rate of 25% will be considered, okay, as the change rate of 30% is neither substantively enacted or enacted on the date of the balance sheet, which is 31st of December 2019. Accordingly, the DTL is recognized for INR 25,000. Even though I may end up paying 30,000, I'm only going to record here DTL of 25,000 because that is the rate which is prevailing, enacted or substantively enacted on 31st of December 2019. So in a way, this is considered as a non-adjusting event. Okay. If the effect of change in tax rate is material, then Popular Limited should provide disclosures in its financial statement for the year ended 31st of December 2019. Let's quickly revisit presentation and disclosures. Always show under non-current assets and liabilities. Numerical reconciliation is required between the average effective tax rate and the applicable tax rate. If there are tax related contingencies, again, temporary differences associated with group investment for which deferred tax liabilities have not been recognized. If there are contingencies, all of that I need to disclose, and disclose. What are the key differences between AS 22 and Ind AS 12? Whole host of differences, right? So there are, first difference is that, the whole P&L approach versus the balance sheet approach, right? Additional disclosure are required under Ind AS, when you look at Indian GAAP from that perspective, lots of additional disclosure are not required under Indian GAAP. They are not required. Such disclosures are required under Ind AS. Revalued non-depreciable asset. Here you don't record it because considered the permanent. Here you're going to record it. From that perspective. And then when you look at on recognized in OCI or directly, here it follows. You're going to record it into the caption in which it has been recorded. And the AS22, we don't have a guidance, right? In fact, we don't have the guidance of OCI itself. So that's an important understanding when you look at the recognition of DTA. Indian GAAP, in a way, talks about convincing evidence, right? If you are having losses, otherwise it talks about, it talks about virtual certainty, right? For unabsorbed depreciation and for business losses, it talks about the convincing evidence, virtual certainty supported by convincing evidence that sufficient future taxable income will be available against which such deferred tax can be. In a way, the bar to record a deferred tax asset, especially when you are having an unabsorbed depreciation or a tax losses, business losses, is very high, very high. Okay, whereas in Ind AS, you actually follow, the probability approach, and you look at that are you going to be demonstrated more likely than not, and if the answer to that is yes, then you should record the deferred tax asset. Okay. Couple of other differences. Recognition of deferred tax on investment in subsidiaries associated, which is outside basis, is not recognized under Indian GAAP. Is, as I said, here you make an assessment, and there are certain exceptions. So you got to look at that. And on elimination of intra-group transaction, right? This is very interesting. Here you don't record this, so you land up with a scenario that there's an entity X and Y, they've done transaction among themselves, which gets eliminated in consolidation, but the tax is not getting eliminated, even if the inventory is still lying within the group. Now in Ind AS, that is being taken care of, and you would ignore, you're going to eliminate that tax expense as well by way of setting up of deferred tax asset, right? All right, so now we'll have a bunch of more questions for you. I'm going to request my colleague to take you through those questions as well. Happy learning. Wish you all the best. Thank you.